Welcome to this weekly macro update. Today, we put a focus on the US labor market, following the release of last month's employment data. Overall, the latest data are encouraging and suggest that the number of jobs created remains impressive, with the private sector creating more than 870,000 jobs in September. But the pace of this improvement is slowing down. In our view, 2 points stand out in the latest jobs report. The first one is a positive one. The unemployment rate declined further, and in particular the EU6 rate, which fell 1.4 percentage points to below 13%. Being forced for economic reasons to work less than 100% previously, this means that 1.3 million people found a job on a full-time basis last month. A second, less positive element is the fact that the number of unemployed that have permanently lost their jobs rose by 345,000 to 3.8 million. This suggests that the adverse implications on the job market of the health crisis will be permanent. It also suggests that it will take a long time to heal the scars from the current health crisis. In conclusion, the US labor market continues to improve, though at a slower pace. The latest data do not change our baseline scenario of a very accommodative monetary policy going forward. We note that employment levels are still more than 10 million below pre-crisis levels, which illustrates the important challenges raised by the economic crisis. In other economic news, we note that latest surveys pose challenges to the recovery in the Eurozone. Indeed, while in Germany and Italy indicators are encouraging, in other countries the situation is more difficult. France, but especially Spain, are countries that are hit the most by the resurgence in COVID-19 cases, and where the services sector is suffering substantially. This puts serious challenges on the growth recovery in those countries and increases further the divergence inside Eurozone economies. More positively, the manufacturing sector, in contrast to services, is continuing to expand strongly. This is also encouraging for Switzerland's export sector. Otherwise, we had some very solid data from the UK housing market. Sentiment in the construction sector is suggesting a solid expansion, while mortgage rate approvals surged and are now at 13-year highs. This is helped by lower interest rates as well as stamp duty land tax exemptions. We expect the positive run in UK housing data to continue. Thank you very much for listening, and see you next week.